Welcome to PM Express Business Edition. Commercial banks have posted some strong numbers for the first half of this year. But are they going to sustain this performance for the next half of 2023? Well, there is talk about the economy recovering, and how is that impacting on the operations of commercial banks in the country? How is the outlook like for commercial banks in Ghana today, post the domestic debt exchange program? Well, that's the topic that is up for discussion on PM Express Business Edition with Chief Executive Mr. John Awuah. John, thank you so much for your time. And some will say that the dust is settling, if I'm right to use that expression.
Thank you very much for having me. In my honest view, I think it's early days yet. We are heading towards a certain outcome as to whether it goes to crystallize exactly what our anticipation is. We have a few more weeks and months and perhaps years ahead to come to a proper like the outlook. I mean, to end in a manner that, as banks, we would say the response has been as expected. We saw in March when we went through the debt exchange, the first one, the domestic debt exchange. We saw that the market responded very positively. It had significant implications or impact on the FX currency movement. It also had an impact on interest rates. We saw the TB rate dropping all the way from 30 upwards of 32, 33 to 19, 18, 19, which was a very good, should I say, market development. Unfortunately, we saw in the last couple of months that rates have started inching up as a country we continue to battle inflation and making sure that at least they use the market rates to also manage.
And sorry to cut in, but are you worried about this development? Because we were all excited when there was this debt exchange program, because one of the good things that was going to happen was that rates were going to trend down. We've seen rates spike significantly to within the 30 range, and some are worried.
Yeah, of course. So, I mean, if you're a market participant, you should be concerned. Worry, perhaps a stronger word, but no, we should be concerned that when market rates, move into the 30s and the 40s, and which company or an individual or household will be able to borrow at that rate and make good on the repayment? It becomes a problem. It has implications for a non-performing loan or the quality of the asset book of the banks. And as banks, as I've said time and time again, that we don't necessarily make money on a higher interest rate per se. We play in the middle. So as the market rates are going up, it means that your depositors will also be asking for higher rates, and which means because your benchmarks will all move up, and that has significant implications. And one loan gone bad is one loan too many, because you are not just losing the interest that you would have perhaps taken over a period, you are losing the interest plus the principal. And if you give 10 loans and one goes bad, it wipes off all the benefit of the other 9. So as banks, we get a bit concerned when market fundamentals are not moving in the direction that we all would say, I don't know to say.
Is it fair for those who would argue that the banks are also, let me use the word, quote, corporate, because you are also demanding or bidding? So some would say that, I know that the dynamics, inflation is high, but some would say, if it's a very educated criticism, that you are indirectly contributing to these high rates.
It's market dynamics. The market mechanics are such that you cannot come in and decide to operate outside of the requirements of the market. If the T-bill benchmark is around 35 or 32 or 30 or 29, how do you come in and be quoting 18 or 14? Because there's cost to the deposits that you are using to also fund these assets. So it's not necessarily a matter of banks becoming like beneficiaries
of the
high
regime.
Rates. Not necessarily. I mean, I beg to differ. You saw from the Bank of Ghana.
They feel that
you saw from the Bank of Ghana report that NPL, heightened NPL levels. We are now losing close to 18 Ghana cedis for every 100 Ghana cedis that we give out.
But some would say, Mr. Whether, what kind of work goes into the loan assessment and appraisal? Because there are a lot of good businesses out there. There are a lot of good clients out there. Irrespective of the terrible environment, they are still able to weather the storms to pay their debts. So if these appraisals are done well, some will say, and forgive me for my ignorance, maybe you'll be able to minimize the shocks when it comes to these very high NPLs.
You see, when market rates move into the terrain where we have now, you can have a very good business. How many businesses are operating on a net margin of maybe 50-60% to be able to afford the cost of funds or finance of 40% or 35%? I mean, I don't know what kind of business that is so profitable that for every 100 Ghana cedis they invest, they are able to return in excess of 40-50% profit to take care of their operating expenditure, to take care of their input cost, to take care of their finance cost. Finance cost alone is taking 30% away from you. So, sometimes I turn back and I say, I mean, are we magicians? How are we able to even accommodate this? So we should all be concerned and to work together in a manner that brings the rate down, in a way, and it all goes into all the things that we do, our demand for FX, which is also fueling the inflation, and also the way we price our products. You see how people price with like 3 months ahead in their mind that rates are going to move in a certain direction. The last couple of months, we've seen rates kind of plateau at a certain rate. Meanwhile, the price of items are still kept at the May-June levels when rates were around 12-13 to the dollar. And these are issues that as media people should also pick up. When rate moves upwards, the speed with which market responds to price in the depreciation, when we see stability or even reduction in rates, we don't see any kind of
commensurate. The uncertainty as well in the environment that some of your players are playing in is forcing them to be extra cautious in these adjustments.
I agree, but the uncertainty must move both ways. You understand? It's not like an uncertainty in a manner that when rates went all the way to 15, so if it went to 15 at some point, and you were pricing at 100 Ghana cedis, and now it's at 11.1, 11.2, and you are still pricing your thing around the 15. I mean, it's a matter of racketeering, more or less.
I'll be coming more to the credit growth and loan extension, but let me just backtrack a little bit. And again, the question about how are banks doing now as we speak?
I would say we have very good banks. Banks are solid, and the way the banks have managed to weather the storm during these difficult periods where we've had to take on quite some significant losses should tell you that banks had built up, the required capital buffers. Of course, there are 1 or 2 or 3 banks that will need, some capital top-ups in order to operate within the regulatory confines. But we have some time through the regulatory reliefs that Bank of Ghana gave to the industry to work our way back into the right capital levels. But as I say, if you are a bank, if the regulator says 3 years, it's in your own interest that you, kind of upfront manage your capital requirements and make sure that if it's 3 years, you are working within a certain shorter period to bring in capital. We have to also take cognizance of the fact that Ghana is not particularly an attractive destination for capital at the moment, given all the market fundamentals that we have moving, more or less against us. But we are coming out. You read the IMF report that said we are gradually working our way out of the troubles.
I'll be coming to that one, but you're talking about capital. The Bank of Ghana asked the banks to submit their capitalization plan. That's the plan. All of you have done that. Now, there hasn't been a communication to an increment, but just submit your plan to improve your position. What is the position of the banks? I mean, that listen, we are not ready for an increment. We are committed to improving our position to meet the current level, but we are not open to any significant adjustment, or what are the concerns in engaging the regulator when it comes to any possible review in the capital requirement?
There is a capital floors that the regulator has set, which is 400 million odd number.
Dollars or 400 million Ghana cedis.
No, I mean,
4 years ago, equivalent to dollars would not be the same thing right now.
Of course, and that is why as a bank, the basic principle is you keep your capital that is commensurate to the level of risk that you are taking. So if you have these risk assets on your books, then that will determine how much capital you need to support that volume of risk or the value of risk that you have on your balance sheet. So the Basel Accord does not technically tell you put X amount of capital. It says that as you are taking on risk, you have to have the right capital levels to support.
But Mr. Ward,
and when it was 400 million,
yeah.
When it was 400 million, there were banks in this country that had in excess of $1 billion in capital.
Yeah.
There were some banks in excess of $2 billion in equity, supporting because of the level of
minimum capital requirement.
Those are significantly higher than the minimum requirement.
Okay.
So the requirement, the regulatory requirement is the minimum benchmark that as a bank you are supposed to keep. But depending on your level of risk that you are assuming, undertaking transactions over transactions, granting facilities here and there, of course that is what will drive the amount of capital that you will need in addition to what the regulatory
you believe that we should rather restrict it to the exposure or risk of an individual bank than the one size fits all. That tomorrow, if Bank of Ghana wakes up and says, okay, in the next 3 years, let's look at increasing the capital to about $1 billion Ghana cedis, that would be a concern. I'm
sure a lot more input goes into that level of assessment. I'm not close to the power to determine what level of capital will be good for the industry. But for whatever it is worth, if the minimum capital levels are set well, and the risk profile of the banks are such that we are keeping the right capital level, which is commensurate with the risk exposures that we have on our books, then there shouldn't be a problem. As you are assuming more risk, your capital...
There shouldn't be a one-size-fits-all where we need a minimum of maybe $1 billion Ghana.
I mean, you definitely will need a capital
400 million Ghana cedis 4 years ago.
You don't want
any... has depreciated so much, qualifying that to the dollar.
The point is that you don't need maybe any Afro Joe to just say that 1 million Ghana cedis I want to set up a bank. That is why it is important that there's a capital floor. So there is a floor below which you cannot go. But that is the barest minimum that you are supposed to keep. And the regulator in setting the floor even gives a buffer. You understand that after meeting my regulatory minimum, you need to top up to this level. You understand? And that is the level that enables you to absorb the nature or the kind of shocks that the industry, went through, early part of this year when we did the DDP one.
I get from you that you are more susceptible to a risk-based capital requirement and exposure than
I think that is the
than a one.
I think that is the direction that the regulator, in the last, a few reviews, have taken. Except that you definitely need the floors to set a minimum benchmark. And then, depending on your risk profile, risk appetite, you top up, with the right liquidity buffers, capital buffers.
So how are the banks doing in terms of, now that they've concluded this domestic debt exchange program? We're getting more details on that one after this break. Welcome back to PM Express Business Edition. As we look at the outlook for the banking sector post-domestic debt exchange program. We've seen the first half numbers, solid, good. I mean, in US, when they are reporting on these numbers, you beat all the estimates. Is that trend going to continue into the next half of the year? Or some are saying that, George, listen, the last year's shocks was for a full year. So wait for a full year to do the comparison. And let us not be rushing ahead of ourselves with the half-year numbers that we've seen.
I mean, I'll go with that school of thought. Numbers are numbers. You don't have to run ahead of yourself. In our view, we have a strong industry that is ready to support economic activities. Of course, we have to also mimic the sentiments, economic sentiments of the country. And therefore, if things are not working very well economically in other sectors, you are definitely going to see its reflection within the banking system. And that is why we are very cautious and very careful in blowing the horn, out of proportion. Yes, the banks are recovering, and so much that we can do, a lot more we can do. But we believe that the market rates must move in a direction that enables us to do even more. As it is now, if you are a bank and you are bullish on loans, you may be taking quite significant risks because of where the market rates are, and very good businesses can struggle during periods such as this, and that is why we are working together to ensure that we get the rates in the right kind of. We all have to be concerned.
So do I get from you that when it comes to the loans, you are now being so cautious now than ever before because of the fact that if it's not handled well, things could affect you?
Of course, we are cautious. We want to make sure we do not unduly leverage the balance sheet in a manner that you sanction loans today and tomorrow you are having to write them off. We want to lend, or the industry wants to lend, but in a more secure, in more safe manner, in a manner that does not unduly open the industry to risk. And in times like this, you need to work with your bank closely, in a manner that your demands are better understood by the institution, and perhaps the product delivery is made in a manner that also synchronizes with the exact requirements, so you do not unduly also over leverage yourself, because in times like this the tendency is to borrow and borrow, but perhaps this is the time to really look at your liquidity profile and try to understand exactly what you need. Maybe it's cost you need to begin saving, so you don't unduly also increase your risk profile.
So that is interesting, because some will say that we've seen the very, very bad situations that you even lend. I mean, we've seen Q1 last year quarter, the last quarter, the previous quarter, and even you were still supporting. And even in the midst of terrible times, you have posted some strong numbers for Q1 and Q2. Some are saying that where is that extra caution from when it comes to lending, that when things are stabilized, rather you are scaling back when it comes to supporting businesses? Not necessarily scaling back,
just making sure that the loans that are sanctioned are loans that you have a very good expectation of getting money back. So it's important that we do not unduly put our clients in a position where interest rate is at 30-35%. Because of that, maybe you come and then you get a facility, you come and you get a facility. There's interest income today. Tomorrow there's going to be impairment facing you as a bank. So that banks are just, as for caution, it has always been part of the playbook of the banks. Either we lend, but we lend with caution, making sure that the various risk acceptance criteria are properly assessed, and that those who are coming for facilities are really those who need it, and the likelihood of getting money back is very high.
So it's a highly, I mean, it's very high that when I come to your end for loan, I might not get it.
That is not the case. That's not what I have said. What I have said is that in an environment such as this, we need to work together with our clients and our and banks and their clients coming together and working in concert to properly assess. And we also have to support our customers by providing advisory services. And part of those advisory services is what I mentioned earlier, that it's not just about giving loans, it's also advising the customer, do you really need it now? Are you sure this is the time at this cost? Are you sure this is the time, for this kind of facility? Is there another financial product that perhaps you may have to explore? So it's more of like talking and understanding the business of your client, making sure that the people taking loans now are companies or businesses or individuals who have the proper earning capacity to pay back.
In terms of profit as well, if I get from you that you're trying to be so cautious, but the outlook, you think that we should tread cautiously, and that for you as the banks, you're not that optimistic of a bullish half year coming on the back of what has happened?
We believe that for an economy or a country, we are at a point where any kind of movement should be a movement upwards. And as banks, we have a duty to support that movement. So we need bankable projects to support. And we call on the business community to look within their infrastructure to see what kind of business they want the banks to support, and banks are there. No bank has put out a warning anywhere that we are not lending.
So you are lending?
No, banks are lending, but of course cautiously, a lot more cautiously. And it is in the interest of both the borrower and the lender that banks are cautious, because if we become trigger happy and dish out liquidity in an environment where perhaps there's subdued demand and economic activities are not at the best place, you need to be careful not to overexpose your bank in a manner that tomorrow it comes to hurt you in impairments.
The IMF has talked about the fact that they are seeing signs of recovery in the economy. Is that impacting on your operations? We've not seen the Q2 numbers, but is this supposed recovery? I mean, if you look at interest, if you look at the CD, if you look at interest rates and all the rest, these are quite interesting in the numbers. Are they impacting on your operations?
I think we need some time to measure impact properly. We are talking about inflation, we are talking about interest rates. I'm not sure inflation and interest rates are at the levels that we would say we are okay with. Market rates are upwards of 30%.
But what about the exchange rate?
Yeah,
the CD has been
it's one factor, it's one factor out of a multitude of variables. We need all the variables to work together in concert to derive a certain market mechanics that enables businesses and individuals to flourish. So it's good. A development of a stability in the exchange rate is positive. Perhaps it has also had some impact on inflationary pressures. Maybe we may be talking about even higher than where we are now on inflation, but you need inflation to come down. Once inflation comes down, the central banks upward adjustments in the monetary policy rates will also be subdued or come down, and gradually we'll find all the market fundamentals moving in a certain direction that enables economic activity. Where we are now is tough to get that. And the IMF document, I read it with more of a forward-looking statement saying that we are on the path to recovery. It's not to say that we have recovered. We are, as a country, we are on a very good path to recovery.
We'll take a short break and we'll come back and wrap. This is PM Express Business Edition. Be right back. Welcome back to PM Express Business Edition. As we look at the banking sector development, the outlook, and whether now that we've finished the debt exchange program, that is going to impact positively on the bank. So going forward, can I get from you that we can tie the stability of the banking sector to the broader economy? Because when the economy recovers, obviously we'll see more lending, a stabilized banking sector, and all the rest.
Absolutely. I mean, you need a stronger financial system to aid the recovery. So once those signs that we talked about a few minutes ago are trending in the direction that we all are anticipating for participating in the debt operations, of course you will find that the banks will be the industry to support those economic activities that will even propel the country out of the recovery, out of where we are now, and fast track our pace in the recovery process. So I think as an industry we have a big role to play in the economic recovery.
Let's look at interest rates. I mean, they're still high. Are we going to see that it's going to be trending down very soon? Or will still be in that high rate regime in terms of lending rate of the bank?
There's a lot more that goes.
What needs to be done?
Is a lot more, and it's a chicken and egg situation. I mean, people have had their own kind of. I'm talking about analysts. Have had their own say on how we, as a country, we are managing interest rates. But we need, once we have a stable inflationary regime where inflation begins to trend in the direction like a lower. We are getting into the 30s, 20s, and inflation. What's the name? Interest for the currency. The currency, the volatility of the currency is also in a manner that is more stable, as we've seen in the last couple of weeks, perhaps even months, where we've been trending around a certain number which is more predictable. We'll begin seeing its flow-through impact on inflation. Of course, if the currency begins having that kind of stability where perhaps even appreciates against the major trading currencies, it will have a flow-through effect on the general price levels, which should affect inflation, which should also have an impact on the central bank's response to interest rates, and gradually the three will move in proper tandem to give us the kind of market dynamics we are looking for.
As we wrap up on this discussion, we've seen the collateral registry report where now the banks are now accepting more movable assets in response to credit extension. For half year, more than 6 billion, almost 6 billion Ghana cedis has been extended. What do you make of this development? And for you, do you think that it is good, it could impact on recovery strongly?
I think so. The ability of borrowers to use alternate collateral assets to back their facilities, broaden the bank's kind of space in terms of the things that we can accept, as a second way out payment for facilities. Working with the DVLA, we are even coming out with a product on vehicles or other movable property like vehicles to secure facilities in a way that the lender is protected and the borrower is also giving some leeway and is able to use these kind of movable assets to support their borrowing needs. It's important that we move to a level where even our digital footprints properly becomes collateralized and we can borrow against measures such as that.
But do we impact positively on recovery as well, NPLs?
Yeah, I mean, we should all, work together. NPLs, bringing it down is when people know that there are proper consequences for default. You have the judicial system working with us, the Lands Commission working with us, NIA, with the Ghana card, all working together to make sure that the lending culture is improved in a manner that does not it makes it easier for financial institutions or banks to recover, when there is distress in the assets that they have given. Basically, that's
but also, what about when it comes to lending? Because when I know that it can easily recover these things, would that make it easier for lending as well?
Of course, the more you are able to recover from loans you have given, it gives you a lot more to give and also more confidence to give more. So it's in our interest as borrowers that when we borrow, we take money from the financial system, we have a proper plan of repayment and that we do not abuse the lapses within the judicial system or the legal framework to the disadvantage of the lenders in a manner that the next borrower suffers.
So my final question for you, the outlook remains good, favorable, or you are cautiously optimistic?
We are optimistic that for the operations that we have all gone through, at least on the local front, the Euro bonds are yet to be settled, but at least on the local front, we demonstrated to the international community that when there's a price to take, market participants have been known to participate, and the outlook can only be greater than where we are now. So,
well, I know the debate will still go on in your offices and in your homes about the outlook of the banking sector and whether things are indeed favorable or not. George Wiafe is the Chief Executive of the Ghana Association of Banks, and I appreciate your time so much. It's been quite a difficult time grabbing you, but I do appreciate so. Well, I know the debate will continue in your homes and your offices about the outlook of the banking sector and whether we are indeed poised for a robust outlook for these commercial banks. And what about the impact on lending as well? My name is George Wiafe. Have a great day.